You need to pay attention to something as we near the end of the year. I want to revisit a set of predictions that Patrick Bet-David made at the beginning about the signs of an economic recession. Now, in the benefit of hindsight, perhaps we can know what to expect in the coming months, especially in the light of recent interest rate drops in September. This is not financial advice, but subscribe and hit that notification bell because you don't want to miss out on this.
Remember a couple years ago how everybody was talking about that a market crash was coming? I've done a couple videos on that. Everybody's like, oh my God, what if it happens? What if it doesn't? Now everybody's talking about it's going to be soft landing. There's not going to be any recession. And there's one thing that people forgot about, the saying, only the paranoid survive. So people are now, it's totally fine. Look at the market. It's near all-time highs. But is it really? If you were to pull out the top 7 stocks, when you see the numbers on this, it's staggering. And on top of that, there is an indicator of when a recession actually hits. And it isn't while we're raising interest rates, the Fed. It happens after we stop raising rates. And wait till you see how long it takes for the market to crash. And by the way, I got a bunch of other data to share with you, but I've learned one thing for sure. Having been in the financial industry since the day before 9/11, only the paranoid survive, and those who are way too confident are typically wrong, and those who are way too cocky are also typically wrong. Here's U.S. interest rate hikes in the history of America. When we raise rates, we have never raised 4.88 percentage points as quickly as we did in the States. So if you look at this here, the yellow to the left shows how quickly we kept increasing rates. And then you'll see the lowest was from 2015 to 2018 when we raised 2 points. Then you'll see 1999 to 2000, we raised 1.51. And then you'll see 2004 to 2006, over 2 years, we raised roughly 4 points. 94 to 95, 2.67. 88 to 89, 3.3. But nothing comes close to the 22 to 23 of 4.88. But what does this really mean? So if we look at the balance sheet of, this is pretty much the quantitative easing balance sheet. If you look at the top, that shows how much bonds the Fed is buying. But if you look at the bottom, the M2 money supply shows how much money is circulating in the economy. So you notice if you go to 2020, look how historically it's gradually climbing, but it's nothing that's sudden. Then all of a sudden, boom, we feed the economy, the market, with trillions of dollars we're not accustomed to. And we don't have another case study for somebody to say, well, here's what's going to happen. Well, it's totally okay. Well, don't worry about it. Based on what? Based on what case study can you speak so confidently saying nothing's going to happen?
Doesn't it sound like all the pieces fall in place when you understand what the Federal Reserve did in late September? By dropping the interest rates by a high of 0.5 percentage point, Jerome Powell's actions didn't quite line with his assurances that the economy was still robust. The federal funds effective rate that's seen a pretty bumpy ride since the pandemic, it remained flat for 2 years before a massive rise in just a single year from 2023. And combine this with the fact that the U.S. has added nearly $6 trillion to the money supply after the pandemic, none of it was going to be without consequence. The only question has been when. Well, if you look at some current indicators as they're placed in volatile geopolitical world, you realize that an economic slowdown or recession has long been overdue. And remember, it's not because of the natural slowdown of the economy that happened as a result of those lockdowns. I'm talking about the recklessness that the interest rates and money supply have faced, to the point that the US dollar itself has lost nearly a quarter of its purchasing power in the last 4 years. And that's all down to inflation, because the aggregate inflation in the country as an absolute figure stands at above 25%. It's only so long before this lowered purchasing power actually ends up in lower consumption spending, impacting businesses and setting off a chain reaction. That's part of the reason why company CEOs report the likeliest prediction of an impending recession.
They did a survey to find out who thinks a recession is coming. Look to the left. The Fed staff says 0% there's not going to be a recession. I remember they're in the business, so they're supposed to be saying that because that is Wall Street, right? Yield curve says 61% chance a recession's coming next 12 months. Economists are at 48%. Consumers are at 69%. That's Main Street, you and I. Goldman Sachs is saying only 15%. Bank of America, 35 to 40%. But look at CEOs, 84%. Okay? C-suites are saying 84%. Now, what would CEOs know that the rest of them don't know? Maybe they know their debt payment. Maybe they know when their debt payment interest rates that they got was lower, that if they have to renew the debt that they got, it's going to go up here. How the hell are we going to make those payments? Maybe we got to look at what some of these CEOs are talking about.
But you know the second part of that equation? Think of what defines the last 2 years, not on the economic front, but more from the technological front in a way that's intricately tied to the economy. If you guessed the advent of AI, you'd be right. It's safe to say that artificial intelligence is going to be as lucrative and impactful as the rise of the internet, but that also means it's going to be incredibly disruptive. That's why experts are calling the time we're in right now as an AI bubble, where too many new AI startups have made too tall promises and gotten away overvaluing. That's something similar to what happened during the dot-com bubble at the start of this century, and we may be seeing something similar today with AI. Of course, if a cascading effect does take such a large segment of the economy, it might topple other sectors of the economy like a domino, similar to what we've seen in other recessions like 2008. And guess what makes that even more real? The biggest companies in America and the world come from technology sectors, which tell you that these mega corporations might be too big to fail, just like we heard the big banks were in the financial crash 16 years ago.
Now, when it comes down to S&P 500, these are the 500 biggest companies in America. Something very interesting is happening. There are 7 companies that make up 28% of the S&P 500. Let me break this down for you. 500 biggest companies, 7 companies make up 28%. In the history of S&P 500, never has there been a time where 7 companies make up 28%. We've never had 7 companies. You know, too big to fail? We've never had 7 companies. Now, what are these companies? You got Meta, Facebook, Nvidia, Apple, Microsoft, Alphabet, Amazon, and Tesla. So why is this important? Here's why. If you look at the S&P 500 year-to-date returns, you will notice a number roughly around 12.4%. Could be higher, could be lower, but it's around 12%. You know what Magnificent Seven's return is for the year so far? Roughly 92%. So what happens if you take the 7 stocks out and there's only 493 stocks left? How's the S&P 500 doing? It's down. So the 7 are pulling the rest of the market, and it looks like everything else is okay.
And that's what's creating the false illusion of a healthy stock market. Plus, it goes to show how using an average index like the S&P 500 doesn't always tell the whole story, because it can too easily be affected by the extremes. If you look at the past 5-year performance of the S&P 500, you realize there's been a gradual rise in the market valuation from 2023 that isn't exactly justified by the fundamentals of the economy. The GDP growth numbers are in 1 to 3 range. The country's business are saddled with the highest corporate debt right now at over $11 trillion, and the consumers themselves are feeling the squeeze in their budgets that's not allowing them to spend as much as businesses would like them to. And then, of course, that problem is taken to a much grander scale when you talk about the United States government in itself.
Who else is experiencing this? Well, these were all small things we're talking about, right? You know who else owes a lot of money? What corporation in the world owes the most money? You know what that corporation is called? The Great United States of America. You know what's going to happen to them every time interest rates go up? Let's break it down for you. So U.S. roughly owes $33 trillion of national debt. Math would tell you and I that each 1% increase in interest rates pushes the government's interest expense up by, you know how much? $320 billion each percent. Each 3% is $1 trillion. Just interest. Increase. Not total, an increase of an additional $3 trillion at each 3%. So just to kind of put that in context, if you look at this chart, look what it shows you. This is the interest expense we've had in U.S. from 1970 till today. You know how it's gradually gone up, but it's not been anything crazy. Then look at it. Boom, skyrocketed. How are we going to make these payments? I have no clue, but they're going to come to you and I because it's really our debt. The government is we the people. You and I are running, we hired these people to run this corporation, but they come to you and I to fund it. So guess who they're coming to very soon? You and I. There's certain things you look at to be motivated and excited about the future. You may want to skip this next chart here, but take a look at this chart here. So again, remember this corporation we're talking about called the United States of America? Here's what this is. The green is the tax revenue our government gets every year from you and I. The orange is our GDP. The blue is our interest payment. And the red is our debt, the $33 trillion debt. Look how many years ago in 1980, everything was right next to each other. Just 43 years ago. They're neck and neck. All of a sudden, boom, the red goes off to the roof.
Guess what happened to around the time those lines started to diverge? It's when the United States moved off the gold standard and the dollar became fiat currency. The government was free to inflate, free to spend, and most of all, free to borrow this fiat currency while kicking the can down the road when it came to paying back the interest. The national debt bubble crisis is decades in the making and will take decades to undo. But in an economy where debt permeates every single business, individual, and government, perhaps we're in the midst of finding out how vulnerable it leaves you in times of crises. Like we saw back in 2020. Let me know in the comments if you agree, because these are not problems that are going away anytime soon.